Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 35, recorded here on October 9th, 2022. This podcast is for entertainment only and is not investing advice, so please, as I always ask, do your own homework. Okay, moving forward here, we'll start out with the market update. Stocks plunged Friday after the latest government data showed a hot U.S. labor market that likely ends any doubt that the Federal Reserve will maintain its aggressive policy of raising interest rates. Non-farm payrolls increased 263,000 in September after a 315,000 gain in August. And the unemployment rate unexpectedly dropped to 3.5%, matching a 50-year low. Among individual stocks on Friday, Credit Suisse soared 13% after launching a surprise $3 billion bond buyback. But Advanced Micro Devices plunged 14%, its biggest daily loss in 2.5 years, after preliminary third quarter sales missed projections by more than $1 billion. Friday's market losses trimmed the gains for what started out as a big comeback week for stocks, with the Dow Jones rising 2% for the week, the S&P advancing 1.5%, and the Nasdaq adding 0.7%. Looking ahead to next week, the Q3 earnings season comes charging in with companies like Citigroup, Delta Airlines, Domino's Pizza, JP Morgan Chase and Morgan Stanley, PepsiCo, United Health, and Walgreens Boots Alliance all set to report. The economic calendar is also busy with updates on the NFIB Small Business Index, initial and continuing jobless claims, retail sales data, and consumer sentiment, although the primary focus will be on hot reads on inflation with the producer prices report and consumer prices report due in. The September PPI report on October 12th is expected to show a 0.1% month-to-month drop. After stripping out food and energy costs, PPI is forecast to rise 0.3% from August and 7.3% compared to a year ago. Bank of America forecasts a below consensus flat PPI reading following 2 consecutive monthly declines, which could tamp down some inflation fears. However, any optimism will be tested when CPI comes in on the next day. B of A forecasts a decline in the year-over-year inflation to 8.1% from 8.3% in August, while a modest acceleration in monthly headline CPI is anticipated to reflect a slower decline in energy prices, down 3.5% month over month, continued elevated food inflation, up 0.7%, and strong core inflation, up 0.4%. The firm thinks core goods inflation will advance by 0.2%, and core services will rise by 0.5%, while rent prices have moderated. That is not expected to impact the CPI print this month. So a lot going on in the markets, and I guess we'll see how the markets react to all that next week. Moving on to Bitcoin news, the first article we have here is from Bitcoin.com. This was posted today. Salvadoran President Nayib Bukele takes aim at Bitcoin detractors, says the ones who are afraid are the world's powerful elites. According to Salvadoran President Nayib Bukele, if the Bitcoin experiment his country is participating in succeeds, a great number of other countries worldwide will follow in the Latin American country's footsteps. Bukele said this in a recently penned opinion editorial called, quote, "Stop Drinking the Elite's Kool-Aid," which was published on September 30th, 2022. In English and Spanish. In the editorial, Bukele criticized 3 camps of detractors, and he believes that most of them are simply afraid of El Salvador's innovative decisions. The most vocal detractors, the ones who are afraid and pressuring us to reverse our decision, are the world's powerful elites and the people who work for or benefit from them, Bukele explained in his article. They used to own everything, and in a way they still do. The media, the banks, the non-government organizations, international organizations, and almost all the governments and corporations in the world. Bukele also denies the many headlines published by media outlets such as Bloomberg, Forbes, Fortune, Financial Times, Deutsche Welle, BBC, Al Jazeera, The Guardian, The New York Times, and The Washington Post that claimed the whole country's economy was destroyed by a $50 million loss. The Salvadoran president said the claims were baloney, and mostly because the country has not sold a single Bitcoin since it started acquiring a stash of Bitcoin. So the argument that we have lost $50 million worth of Bitcoin is false because we simply have not sold any Bitcoin, Bukele's editorial insists, and even if we were to accept that argument as true, then it would be ridiculous to conclude that an economy of $28 billion per year will go bankrupt or into default because of a 0.2% loss in 1 year, when in 2021 our economy grew 10.3% or by $4 billion. This is using the IMF's own numbers. Bukele's opinion piece further adds, in 2021 our GDP rose 10.3%. Income from tourism rose 52%, employment went up 7%, new businesses up 12%, exports up 17%, energy generation up 19%, energy exports went up 3,291%, and internal revenue went up 37%, all without raising any taxes. And this year, the crime and murder rate have gone down 95%. The Salvadoran bureaucrat details that he understands that Bitcoin is a very large experiment, and he believes it's absurd to claim that the country has already failed. His recent statements are similar to Bitcoin's inventor when Satoshi said, "I'm sure that in 20 years there will either be a very large transaction volume or no volume." Similarly, El Salvador has joined the grand experiment, and time will tell if the Latin American country's bet succeeds or fails. If it does succeed, Bukele's editorial asserts that many countries will follow El Salvador's lead. El Salvador is the epicenter of Bitcoin adoption and thus economic freedom, financial sovereignty, censorship resistance, unconfiscatable wealth, and the end of the kingmakers. They're printing, devaluing, and reassigning the wealth of the majorities to interest groups, the elites, the oligarchs, and the ones in the shadows behind them, pulling their strings. Bukele's article concludes, if El Salvador succeeds, many countries will follow. If El Salvador somehow fails, which we refuse to, no countries will follow. So, very interesting piece from Najib, I think is how he pronounces it. A lot of people discount what he says because they say, well, he's just a Latin American dictator and what does he know? But I think the proof is in the pudding, in that his economy is doing quite well. There's a lot of tourism, a lot of interest in the Bitcoin space, and people going to visit, and also people starting businesses there. Since they did make Bitcoin legal tender in El Salvador. So it's certainly too early to declare it a failure, and I think it's very, very early days, and it's good to see, and hopefully they are successful, and there will be other countries that follow suit and are able to leverage Bitcoin to improve their finances and their society and all that. Next, also from Bitcoin.com, this was also posted today. New PayPal policy lets firm fine users $2,500 for spreading misinformation. Terms of service condemned and called an abomination. Now, it's funny because this came out and then they had to sort of hastily retract that, say it was a mistake in their Twitter due to the blowback, but there's still just a lot of people that are really upset. So anyway, we'll get into it. A new PayPal user policy that permits the company to fine users $2,500 for spreading misinformation has caused quite a stir on social media platforms after November 3rd. Anyone who posts or publishes information or content to, quote, promote misinformation will be subject to the penalty. And then there's an editor's note here. This article was updated to reflect that PayPal has retracted the user policy information after the social media backlash. The company said an AUP notice recently went out in error that included incorrect information. The last paragraph in this article contains the full statement from PayPal concerning the user policy. So the Payment Services Corporation PayPal reportedly plans to update its user agreement with a new clause added that fights against so-called, quote, misinformation. A new update added to the restricted activity section of PayPal's user agreement shows that people who post or publish hate speech or misinformation may subject you to damages, including liquidated damages of $2,500 US per violation, which may be debited directly from your PayPal account. The Daily Wire first discovered the upcoming Terms of Service agreement. The prohibited acts include the sending, posting, or publication of any messages, content, or materials that promote misinformation. The payments company warns. Of course, the news wasn't taken too kindly by the general public, and a significant number of social media posts criticized PayPal's decision to implement the new user agreement. Canadian lawyer David Anber wrote, "Hey PayPal, you have 30 days to explicitly renounce this abomination of a policy, or I'm permanently closing my account, as will millions of others, I'm sure. Your subjective views on misinformation or discrimination don't entitle you to your client's money." Moreover, the PayPal news caught the attention of Tesla executive Elon Musk when an individual wrote that the new terms of service news was worrying and that's why we need the X platform more than ever. Musk responded, 100%. Bitcoin supporters, of course, took to their Twitter handles and exclaimed that Bitcoin fixes this. A great number of people on social media begged others to close their PayPal accounts and boycott the payment services company. PayPal's new policy lets it pull $2,500 from user accounts for promoting misinformation. The Biden administration made easier for the government to spy on Americans. The FBI is acting like the KGB, Pedro Gonzalez wrote on Saturday. Venmo is owned by PayPal, which is owned by eBay. Pull away from all three ASAP. Another person tweeted, a number of individuals asked how PayPal decides what information is misinformation or not, and many said current times are akin to a communist regime. One person wrote, and who decides what misinformation is? Why, PayPal, of course. I'm sure they'll be fair. Twitter will restrict your account if they don't like what you post. PayPal has authorized itself to assess monetary fines for bad behavior. Welcome to the Soviet Union. And along those lines, actually, Twitter just, I think, blocked a tweet that was sent by the uh, uh, head of the state of Florida's health department because it was misleading as it related to COVID. And then I guess they had to reverse themselves and unblock it. But certainly, centralized platforms are a great opportunity for censorship of all sorts. PayPal has been accused of censorship for a long time now and picking and choosing sides based on the firm's own subjective valuations and, of course, state orders. At the end of July last year, PayPal revealed it partnered with the nonprofit organization, the Anti-Defamation League, and said it planned to study financial transactions that funded extremism and anti-government groups. In 2010, PayPal and a number of other financial giants blocked WikiLeaks from getting donations, and it pushed Julian Assange and the nonprofit toward Bitcoin. In 2019, PayPal shut off ties to sex workers, leveraging the adult web portal Pornhub, and at the time, 100,000 adult performers were left stranded. In 2020, PayPal merchants who sold products associated with the eight-legged microanimals called tardigrades or moss piglets had issues with the payment processor because the name tardigrade was used by a Vulcan arms dealer. According to Eric July, owner of Rippaverse Comics, 2 months ago, PayPal gave him significant issues when he sold Rippaverse Comics using PayPal and credit cards. At the time, $1.2 million was put on hold by PayPal, and on October 6, July said that after making an erroneous error of only paying him back half the funds, the other half was released, and there was no official statement from PayPal as to why. After a huge hassle, July got back all of the initially held funds, and he further stressed that his firm would never be using PayPal again. The Rippaverse Comics owner added, "It's a piece of shit company, and I recommend that small business owners especially avoid using them." On October 8th, a PayPal spokesman explained to the National Review that the user policy notice shared wildly on Twitter and publications was a mistake. An AUP notice recently went out in error that included incorrect information. The PayPal spokesperson insisted PayPal is not fining people for misinformation, and this language was never intended to be inserted in our policy. Our teams are working to correct our policy pages. We're sorry for the confusion this has caused. Oops. My guess is if nobody picked up on that, it would have just stayed there. And good luck if you came in conflict with that. So bravo for the internet for bringing that up, and we certainly need to be mindful of these types of things in the future. Okay, moving on, it's also from Bitcoin.com, also posted today. Robert Kiyosaki explains why he buys Bitcoin, citing pension funds and inflation. The author of Rich Dad Poor Dad, Robert Kiyosaki, shared why he buys Bitcoin in a couple of tweets Friday. Rich Dad Poor Dad is a 1997 book co-authored by Kiyosaki and Sharon Lechter. It has been on the New York Times bestseller list for over 6 years. It's actually the first personal finance book I ever read, and it's great. I actually had all my kids read it and gave them a reward for giving me a book report on it because I really wanted them to learn about personal finances at a young age. So, more than 32 million copies of the book have been sold in over 51 languages across more than 109 countries. In one tweet, the Rich Dad Poor Dad author detailed that he buys Bitcoin because pension funds are buying the cryptocurrency. He referenced an article published by Forbes titled "Your State Pension is Now Gambling on Cryptocurrency," which features a survey showing that 94% of America's state and local government pensions are investing in cryptocurrencies. Tweeting the article to his 1.2 million followers, Kiyosaki wrote, "Why I buy Bitcoin. Pension funds are the biggest investment businesses in the world." The survey is part of the latest investor trust study published in April by the CFA Institute, the Global Association of Investment Professionals. The study showed that institutional investors have become bigger users of cryptocurrencies, with two-thirds saying they are currently invested in these products. In addition, government-sponsored pension plans are the most likely to be invested in crypto assets. In another tweet, Kiyosaki elaborated on why he has recommended buying gold, silver, and Bitcoin. The famous author explained that when pensions nearly collapsed, it exposed central banks cannot fix inflation. He noted that pensions have always invested in gold and silver, and now they're investing in Bitcoin. And his tweet actually says, "Why buy gold, silver, and Bitcoin? Bank of England pivot means more GSBC. When pensions nearly collapsed, it exposed central banks cannot fix inflation. Pension have always invested in GNS. Pension funds now investing in Bitcoin. They know fake dollars, stocks, and bonds are toast." Last week, the Bank of England told lawmakers that a number of pension funds were hours from collapse when it decided to intervene in the British bond market after a massive UK government bond sell-off. Of course, we talked about that in last week's episode. Kiyosaki also stated in his tweet that pension funds know that fake money, stocks, and bonds are toast. The famous author recently warned that the end of fake money is here, urging investors to invest in, quote, real money, namely gold, silver, and Bitcoin. The renowned author has been recommending buying Bitcoin alongside gold and silver for quite some time. Last month, he urged investors to get into crypto now before the biggest crash in world history strikes. He noted in June that he's waiting for the price of Bitcoin to test $1,100. Last week, he said that as the Federal Reserve continues raising interest rates, there will be buying opportunities in gold, silver, and Bitcoin. He also predicted that the US dollar will crash by January next year after the Fed pivots. And I certainly agree with him on gold, silver, Bitcoin as a great way to sort of preserve your wealth. I don't know if it's going to drop to $1,100, but if it does, that's fine. Buy more. Okay, next article here, also from Bitcoin.com, also posted today. Veteran trader Peter Brandt suggests all Bitcoin acquired in 2021 is a, quote, losing trade, reignites feud with Laser Eyes movement. Veteran trader Peter Brandt recently reignited his feud with Bitcoiners who use laser eye crypto memes after he reminded them that every Bitcoin purchase in 2021 is at the moment a losing trade. Brandt added that even he could not have predicted that the crypto would be trading under $20,000 in October 2022. In response to the veteran trader's tweet, Michael Saylor, who recently left his position as CEO of MicroStrategy, explained why he and other Bitcoiners are still committed to the Laser Eyes cause. He said, "Laser Eyes signifies a long-term commitment to Bitcoin based on its ethical, technical, and economic superiority to alternate assets. All major financial asset classes have been losing trades over the past year. That is why we don't trade, we hodl." Saylor's remarks were echoed by another Twitter user named Stephen Livera, who insisted that the key aim of those ascribing to the Laser Eyes movement is to increase our number of sats stacked and freedom acquired. In addition, the user also appeared to attack Brandt's use of technical indicators when seeking to understand an asset's future price movement. Predicting short-term price movements is a fool's errand. Growing and advancing the movement is the real goal, Livera tweeted. Alex Gladstein, a human rights defender and supporter of laser eyes, reminded Brandt that the idea was simply to put them on for the journey to 100K. Gladstein predicted that the laser eyes movement is not going to relent until one Bitcoin is equal to $100,000. When one Twitter user called Bazooka responded to Brandt's tweet by claiming to have bought Bitcoin when the crypto asset's US dollar value was between 17 and 18,000, the veteran trader shot back, reminding the user that Bitcoin never traded under 24,000 in 2021. However, when John Bollinger, a technical analyst and inventor of the Bollinger Band, suggested that Brandt's tweet was a bit mean, the veteran trader concurred but insisted his aim was to remind supporters of the laser eyes movement that the dangers of dogmatic thinking. During the 2021 crypto bull market, many Bitcoin maxis began adding red laser eyes to their social media profile pictures. Using the red laser eyes then signified the holder's bullishness. As the movement was gaining traction, Brandt became one of the first prominent traders to question the movement, which he compared to a cult. For instance, on March 31st, 2021, when Bitcoin was trading above 58,000, Brandt said, "I will use my laser eyes when Bitcoin experiences a 50,000 correction and many of you swap your lasers for tears." Months after Brandt said this, Bitcoin went on to hit an all-time high of $68,789.63. However, since then, the top cryptocurrency has trended downwards and is primarily traded between 23,000 and 18,000 since September 1st, 2022. Yeah, I mean, okay, he's got a point. Don't be dogmatic. And I'm certainly, not 100%, all in type of a person. But of course, I'm a bit older, and so I have to really focus on, retirement and balancing volatility. But I still think Bitcoin's an important wealth preservation tool, and I don't have laser eyes in my profile, but I do think it's an important part of your portfolio. And uh, I don't view it as a trade. I view it as a buy and hold asset, and something that will go to future generations. And hopefully I'll never need to use it in retirement because I'll have other savings. But that's at least the plan. Moving on to the second to last article, I guess, here. This one's from CoinDesk. This was posted on today. Bitcoin mining this is an opinion piece. Bitcoin mining is cool again. We can thank Africa, prudence, and growing hash rate for that. It has been a tough year for crypto mining industry, but the industry is primed for a rebound soon. This is by George Kaludis. Crypto mine, and by the way, I'll include links to all these articles in the show notes if you want to read it for yourself. Crypto mining companies have struggled mightily in 2022, but over the last week or so, the tide may be turning. One shred of evidence came from Barclays, which initiated equity research coverage on Core Scientific earlier last week, issuing an overweight rating. Now, an overweight rating isn't a buy this now, oh my goodness, what a steal. This stock is liable to rip your face off rating. Instead, it's more of a, hey, this thing will perform well compared with its peers. Basically, if mining stocks don't go all up, at least cores won't go down as much as the others. Not exactly a strong suggestion that mining is back, but it's objectively better than everything is going to zero and our best days are behind us. But beyond this one stock rating and otherwise positive stock performance the last 2 weeks, the tide against mining is turning. Mining is cool again. Banks' equity research teams spend time writing about companies because A, the banks think the companies operate in an important industry, and B, the covered companies might need to raise capital someday, and they just might choose that bank to raise capital on their behalf if they get a nice write-up. Barclays initiating coverage on Core Scientific itself isn't too far out of bounds, but what was a bit surprising, at least to me, was the report mentioning that we remain positive on the long-term viability of Bitcoin, and we view cores positively in light of our long-term bullish view on Bitcoin. Barclays isn't some nobody bank pandering for clout, so if the idea that Bitcoin has long-term viability penetrates more and more banks, the financiers at these banks will be excited about the opportunity of servicing the mining businesses that secure the Bitcoin network. But for now, let's put Wall Street aside and shift our focus to Africa. Chainalysis, a blockchain forensics company, published a report 2 weeks ago suggesting that crypto is thriving in sub-Saharan Africa. Of the regions Chainalysis studied, data showed that sub-Saharan Africa accounted for the least amount of transaction volume of any region. But a deeper look at the data shows the region is experiencing a grassroots crypto movement. Africans conduct the world's highest proportion of retail payments of less than $1,000, 80%, and carry out far more peer-to-peer transactions proportionally, 6%, than all other regions. The report was well summarized by my colleague Frederick Munawa. CoinDesk managing editor Christy Harkin added important color on CoinDesk TV by comparing El Salvador's crypto adoption, where Bitcoin is legal tender, with African adoption. She said, with El Salvador, we're looking at a situation where the use of Bitcoin was implemented in a top-down way. To contrast that with the strong crypto usage and adoption rates in African countries is from the bottom up. In fact, adoption is going against what their governments would prefer them to do in many cases. I think that's an important point, and while the Salvadoran legal tender law was sparked by a circular Bitcoin economy that cropped up at Bitcoin Beach in El Zonte, a coastal town in El Salvador, it's still a law that requires the adoption of Bitcoin. Back to mining. Last Tuesday, there was a video making the rounds on Twitter of a micro hydro plant in rural Kenya implemented by a company called Gridless. This is great. A village in Kenya that doesn't have reliable electricity now has it in a way that isn't completely obtrusive to the surrounding ecology. The kicker? The hydro plant is also mining Bitcoin with the excess electricity to offset costs. The plant was intentionally overbuilt, and according to tweets from Luxor Technologies CEO Nick Hansen, the mined Bitcoin could effectively reduce power prices by up to 90%. This is really one of the coolest things I've seen in a long time, partially because electricity is awesome, but also because it gives credence to a popular Bitcoin trope. Bitcoin mining provides an ideal way to monetize otherwise stranded, cheap, renewable energy. As I wrote in April for CoinDesk Research, Bitcoin mining could be economically impactful to communities near these stranded energy sources as they're able to monetize their proximity to cheap energy sources. And here it is. This is just one example, but a rural community can now enjoy cheaper electricity because of Bitcoin mining. Surely there are more out there, and there are more coming. Another reason why this is cool is because it is emblematic of how fragmented and therefore decentralized Bitcoin mining can be. Yes, there are sleek, put together, and publicly traded corporations mining Bitcoin in big warehouses, but there are also rural communities that can just as easily mine Bitcoin. Of course, even though I offered positive stories above, there's still the reality that the mining business has taken a hit this year. As I wrote in May, there there's no particular reason to worry about the mining industry as a whole. Bitcoin mining will be fine, but the cast of characters might change since the capital markets are available up until the moment they aren't. Bitcoin will be better for it, but there might be some pain coming at the company level. And we saw that pain. We've already talked about stock performance, but there's more. Last week, CoinDesk reported that Bitcoin mining company Marathon had invested $31.3 million in Compute North, which filed for bankruptcy last month. CoinDesk also reported that publicly traded crypto mining company Argo Blockchain raised $27 million in equity capital due to liquidity pressures, in tandem with selling 3,400 of its mining machines. On top of the corporate pain, Bitcoin mining machines have been offered for sale on third-party selling platforms like Kaboom Racks at steep discounts. Clearly, things are tough right now, and the consensus seems to be it'll get worse before it gets better. But I think mining is on the come up. On October 2nd, Luxor Technologies head of research, Colin Harper, wrote, Bitcoin's hash rate is absolutely popping off right now, rising some 8% over the week to a new all-time high this morning. On October 7th, hash rate, the total computational power being used to mine Bitcoin, was around 260 exahash per second. That marks a 24% increase over the last 3 months. Due to the increase in hash rate, the Bitcoin network is set to make it harder to mine Bitcoin. This is called the mining difficulty adjustment. And again, this is something I've talked about in prior episodes. performed automatically by Bitcoin's code roughly every 2 weeks. And because it's relatively aggressive upward adjustment, there's pessimism around the short-term prospects for mining. But here's why I'm not pessimistic. Things got tough for mining companies, and the companies that have survived are the companies that were operating responsibly and prudently. Some companies were taking advantage of the cheap capital available to them because of low interest rates to run their business, and that's simply not possible anymore in a rising interest rate environment. The mining companies that have endured this shakeout are simply the best of the bunch. On top of that, creative ideas like rural micro hydro plants that mine Bitcoin in Kenya are cropping up, and the injection of creativity into the space gives me optimism. To cap it off, the network's hash rate is growing quickly in spite of the fact that Bitcoin's price isn't really exploding. Typically, a higher Bitcoin price would encourage more people to mine since the rewards are potentially greater. So instead of miners simply piling into the network in a quest for massive gains in Bitcoin, they are joining because it is a prudent business decision now that the network has proven staying power. Not to mention, October is a historically positive performing month for Bitcoin, so Bitcoin trading in a tight band between $19,000 and $20,000 might not last very long. So with all these things in, I'll say it again, mining is cool again. So not too much to add to that, except that the rising hash rate is a good sign of strength in the network, and you really can't be confused with the price being down around 19, 20,000, which it's held reasonably well uh, here in this bear market that we're in. And the last article here, this is from Crypto News. This is another piece, I guess it's an opinion piece. Frederick Vold, Bitcoin whales accumulating Bitcoin at current prices. What do they know? Bitcoin whales are again accumulating Bitcoin, with more and more traders now asking themselves what these whales know that the rest of us don't. According to data from the crypto analytics platform Santiment, the so-called Bitcoin whales, defined as wallet addresses holding between 100 Bitcoin and 10,000 Bitcoin, have added a total of 46,173 Bitcoin to their holdings since September 27th. In a tweet published earlier this week, Santiment called the increase a sustained accumulation by whales and noted that this has been a rarity in 2022. The firm added that the increase in Bitcoin holdings has come as large holdings of the stablecoin Tether have dropped. The findings indicate that some of the largest players in the Bitcoin ecosystem are using stablecoins to add to their Bitcoin holdings. This also means that any price rallies seen in recent days have most likely been stablecoin driven, without support from a significant level of fiat inflows. It is widely believed in the crypto community that large inflows of fiat currency into Bitcoin and other cryptocurrencies is necessary for a new bull market to establish itself in a sustainable way. Still, it shouldn't come as a surprise when whales are among the first to position themselves for potential future rallies in the Bitcoin price. As a result, the positioning seen in the past few days could be a sign that the wealthiest Bitcoin holders are now betting that the macroeconomic conditions will improve going forward and that this will ultimately help Bitcoin move higher. Meanwhile, the news that whales are now accumulating Bitcoin comes after Santiment in late September reported that the whale holdings of Bitcoin had dropped to the lowest level in 29 months, making up only 45.72% of the circulating Bitcoin supply. In a tweet at the time, the firm attributed the fall in whale investment interest to fears of inflation and a world recession. So again, another interesting piece of data. And of course, I think I've talked about this in past episodes that I do feel like Bitcoin's at a price level that's attractive to accumulation. Um, and if you're dollar cost averaging, you kind of don't really care what the price is. But if you have some extra cash, you're looking to buy, it's certainly better down around these levels than at $50,000 or $60,000 for sure. Will it go down lower? Possibly, and that's why. But if you're accumulating and holding for the long haul, you're typically not going to be too concerned if it goes down a little bit more. And it certainly seems that the risk reward is quite good. And I think the same is probably true of gold and silver as well. So, Okay, so that wraps up the Bitcoin news for the week. And this week's topic, I'm just really going to talk a little bit about staying the course with investing because I know it's been very difficult, for the average investor dealing with the stock market losses, bond market losses. The so-called risk-averse investors with the 60/40 portfolio have gotten clobbered this year as interest rates have gone up and everything's sold off, even gold, silver, Bitcoin, stocks, bonds. The only thing that's really performed well is the dollar and oil this year. So it just gets very tempting to, and I've certainly done this a couple times in my investing career, where you just throw in the towel and sell at the bottom and then miss out on the upside. So, so really, these are just some tips, I guess, on staying the course with your investing that have worked well for me. And you do have to be active. I don't think set it and forget it is a good strategy necessarily. Certainly not for everybody. If you're younger, I guess you can afford to just keep piling into index funds and just wait. You can stay 100% long, but if you're older and you get closer to retirement, you really want to focus more on preserving your wealth and not suffering huge drawdowns. Um, I think first and foremost, working off of portfolio strategy is really important. I try to look at that once a month, and I talk about that on this podcast and in my blog. Um, and it changes. I think that in this last month, I got a lot more defensive after selling a piece of property, just kind of holding a bit more in cash. But I do still have, long positions because, you kind of need to, you can't be out of the market completely at all times. You got to be in, but you also want to wait for you know, confirmation that things are improving. And right now, you know, uh, it seems like, the markets just are going to continue to struggle until something changes. And that something is really the Federal Reserve. Um, I think it's also really important not to react to headline news, especially with online trading accounts. It's so easy to just like read something, panic, and then click the sell button. So I think it's really really important to, especially mainstream media. You have to think like, okay, why is this news, and what does this really mean, and really maybe even look at some other sources to ascertain whether or not that really is something that you need to do something about. Um, Probably more important than that, I think, is just financial education. So it's really learning a lot about the macro environment. It's really essential, and it's an ongoing thing. And whether you subscribe to newsletters or um, blogs, there's so much free information out there. In fact, I think I'm going to probably put a list together of all the financial blogs that I follow that are free on Substack. There's just some incredibly good information that's free, that's available, and takes a few minutes to read some of these things. But it really helps, and it's essential, I think, to understand the macro environment, to understand how everything works. Um, and then I think, if you do make portfolio moves, I think they need to be planned. They need to be deliberate, and probably if you're going to invest in something out of cash, you probably want to start small and scale into it. And you really need to understand what your goal is. Are you trading, or are you buying something that you're going to hold on to for a long, long, long time? The other thing is diversification, which is, I think, really, really important. It's really hard to pick a winner, And so it's good to have a variety of different investments. Um, and as long as they're, whatever your long-term theme is, if you're worried about inflation and you're going to skew more towards inflation defense, and that's kind of where I tend to go with hard assets and things like that. But um, diversification, I think internationally, diversification across asset classes is super important. And then I kind of like the George Gammon rule, I'll call it. He's a podcaster that I listen to a lot, puts out some really good content. Rebel Capitalist show is actually the one I listen to the most. But he's got a pretty simple rule, which is just try to buy assets when they're cheap and sell them when they're expensive. And I think that I totally agree with that. The only thing is, you wouldn't. That's like a trading mindset. So if you're just accumulating for wealth preservation, like you would with gold or silver or Bitcoin, you would probably just be accumulating those at a attractive price point and then just holding on to them. Um, you do need to focus, you're investing on wealth preservation. And again, depending on your age and your risk reward profile, like for me right now, I look at gold, silver, Bitcoin, cash as really wealth preservation. And I think based on my last portfolio update, I'm about 67% in wealth preservation right now. That's going to change in the future, but and certainly I wouldn't be selling any of my gold or silver or Bitcoin. I would just be accumulating more, but maybe putting some of that cash to work in the second category, which again for me right now is about 33% of my portfolio, which is wealth growth, which primarily stocks. And I think the stocks that I like in this environment are probably commodities over the next 5 to 10 years. So miners, oil and gas. Um, not as excited about other types of equities. Maybe if interest rates really start to drop, then all of a sudden tech stocks catch fire again. But um, we seem a long ways away from that, and I think we're probably going to be in an elevated inflation environment for at least a little while longer. Because you have to remember too that even if the inflation rate stops growing, it's still compounding, and everything is going to get more expensive as long as there's supply chain disruptions, war going on, and um, you know the high oil and gas prices are going to drive through everything because that's a key input for just about everything, including commodities. So. Uh, the other things for wealth growth, obviously real estate, I've talked about many times, private companies, investing in private companies and startups. Again, you have to be really patient and you have to be able to hold for a long period of time, but those are good for a portion of the portfolio. And sometimes the best thing to do is nothing. It may feel like, you know, there's an urgency, and sometimes the best thing to do is just leave it for another week and or another couple weeks or a month uh, or next quarter. I think you shouldn't feel like you need to always be trading and always moving things around. And then finally, just observe and read broadly. I think sometimes you find things are connected in a weird sort of way. Like you may read an article that has nothing to do with finances, but then you can connect it back to your investing and how there might be, a theme or trend or something that you pick up on. So I think that's really important. So anyway, those are my thoughts on staying the course. I think it's really important not to overreact. It's important to be defensive in times like these, but it doesn't mean give up. It doesn't mean throw in the towel. It just means you have to really do your homework and study what's going on, whether you use an advisor or an investment manager or not. ultimately, I think it's about personal responsibility for your money and making sure that you're following through with that. So anyway, thanks for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can also follow my Substack at bitcoinfortress.substack.com, and you can follow me on Twitter. My handle is at Nick Reichert, and I only try to tweet things that are signal and avoid noise. So check it out, and I will talk to you all next week. Bye bye.